Well, hello. Camilla Jeffs here with Steady Stream Investments. Today, we're talking about taxes. Woo! Okay, I get it. Not everyone is excited about taxes. And, I used to dread tax season until I became a real estate investor. And I realized that actually the tax code is hugely beneficial for investors. So, in this video, I'm going to discuss the 5 tax benefits to passive investing. Now, here's a mindset shift for you. Try not to spend so much energy minimizing the impact taxes have on your day job income. After all, really, there's only so much you can do. What you should focus on instead is investing your capital in a way that is extremely tax efficient. Now, before we dive in, you need to know I am not a CPA. So please consult a tax professional for your particular situation. Okay, let's dive in. Number 1, depreciation. This deduction is huge and often overlooked. So, depreciation is when the IRS allows you to deduct the cost of items that have a shelf life, like the building itself, or the carpet in the building, or the fixtures. Because over time, real estate is going to start breaking down. But fortunately, you're allowed to write this off based on the wear and tear. Now, how does it work? Well, first, you have to determine the value of the actual building, and that's apart from the land. And then you're going to divide that value by the useful life of the property. Now, according to the IRS, lifespan equates to 27.5 years for residential property and 39 years for commercial property. And then every year, you get to deduct that precise amount. Now, there's a cool thing that happened. The Tax Cuts and Jobs Act of 2017 changed the rules around depreciation. So businesses can now accelerate the timeline of the depreciation and take it earlier. So this increases the amount an owner can depreciate and deduct early on. In fact, because of bonus depreciation, you're able to deduct about 25% of the purchase price of the building in the first year. So if a building was $4 million, investors are able to deduct $1 million in the first year alone. Now, this has a huge impact on what shows up on your K1. So for a passive investor, it often shows up as a loss anywhere from 50 to 100% of your initial investment amount. So I've invested in deals and received distributions, and on paper, my net income looked like a big old loss due to the large amount of depreciation early on. So what happened? Well, I didn't have to pay taxes on the distributions received, and it could actually offset gains from other real estate investments I made. So all these deductions you've taken, they do have to be accounted for when the property is sold. So keep that in mind. I mean, Uncle Sam still needs his cut, right? But the rate is maxed at 25%, and you've been deferring paying taxes for several years. All right, number 2, capital gains. Capital gains are the profits from selling an asset. Of course, this is counted as income. It will be taxed. But the tax rate is different than the rate for your traditional income. So real estate income, as long as it's held for more than a year, is treated as long-term capital gains. And that tax rate caps at 20%. That's a far cry from 35 or 37% you might have to pay on your day job income. Now, if you compound those gains over time, it becomes even more significant. Number 3, refinancing. Refinancing is my favorite. It's a great way to purchase additional assets, but with a refinance, you can borrow against the appreciation and increased equity of a property, and it's all tax-free. So, for example, let's say you invested in an apartment complex as a passive investor. And after 3 years, the apartments have been renovated, rents have increases, and the sponsor team has decreased expenses. So now the property is worth a lot more. So the sponsor team does a cash out refinance, and they give you back 75% of your initial investment. This process completely tax-free, and you can utilize the cash to continue growing more streams of passive income. Pretty cool. Number 4, mortgage interest deduction. So you know that in the early part of a loan, right, the majority of a payment goes towards the interest of the loan. And those payments can be deducted, the interest part, right? So just as with a traditional home mortgage, interest payments from a rental property can also be deducted. These can definitely add up, especially in the first few years after purchasing a property. Number 5, loss carryover. So all these deductions, right? They end up showing as a net loss on paper, at least. And this can be a great thing because all the distributions you receive are essentially tax free. But if all of those losses exceed your gains, then you can actually carry the losses forward to offset future passive income. Now, adding up all the deductions and benefits, that can result in huge gains as an investor. And then you compound them over time, and it's pretty clear how this can result in significant wealth building. So, all of these tax benefits are in addition to the income you are earning from the investment. In order to build wealth, it's not enough to earn ordinary income. You also have to know what strategies can maximize your tax benefits. Now, investing in real estate group investments provides regular people like you and I the chance to build wealth quickly while also mitigating risk. Thanks for joining me. If you're interested in learning more, subscribe to this channel and then head over to steadystreaminvestments.com where you can join our investor list and begin your passive investing journey to your success.